Welcome to Module 3 of Week 6 and Estate Freeze. In case you can't figure it out, this is a refrigerator. Took me a little while to figure it out too, so don't feel alone. Our goal of our estate freeze as authorized under Chapter 14 of the IRS Code is really to be able to make maximum use of the IRS Code and tax laws to transfer assets to the next generation at very favorable rates. But basically, by allowing the current generation to reduce their ownership and pass it to the future generation at very low estate tax rates. In fact, sometimes you will see that you don't even have to pay estate tax. And this is especially useful for companies that are growing. I had a client who had a business he started basically with $100,000 of capital that he borrowed against his house. In 10 years, it was worth probably 50 million, and the last I saw him, it was worth probably over 100 million. And that business, he was planning along the line, and when he dies, that he'll probably pay a nominal of any estate tax, and his children will be fully owning the business. So it is something set up under 14 of the IRS code to make this happen. And it isn't, I've had some people say to me, oh, the IRS doesn't like it, but the IRS loves it because it's exactly what the code says you're supposed to do. Now, did they like getting around the estate tax? Let's face it, there's so many rules allowing you to get around the estate tax that I don't think that's really an issue. Their opinion, and from what I can see, is if you owe them money, you pay it. If you don't owe the money because you found ways around it, don't pay it. That's not a problem. Okay, so the idea is retain a value of assets at or near its current value, and that's relating to businesses. So a business might be worth, say, 10 million today, and you're 35 years old, and it's growing quite well, and you feel by the time you reach 65, due to your good business techniques as well as inflation, it's worth 100 million. How do I keep my taxes at the current value or less? You do this by transferring the appreciation rights to another, such as the children and grandchildren. Again, a nice way to get around the generation skipping tax. And finally, of course, it reduces the taxable estate. The best example that people use in textbooks and probably in real life too is the preferred stock recapitalization. I think you're all aware if a corporation starts out, it's basically going to have common stock, and all the common stock holders get to vote on things. And then if you want to recapitalize to add in preferred stock to have, in effect, ownership with the priority of getting some benefits that normal shareholders don't get, which is usually a preference on dividends, then you use preferred stock, and that recapitalization is tax-free, so we don't have to worry about the tax implications, and it's relatively inexpensive to do with your attorneys. And again, probably the biggest problems are some states where you're incorporated make it a little bit more difficult than others. So if you have an attorney who works with the states and has your company incorporated in New Jersey or Delaware or Idaho or Arkansas or Arizona, etc., Nevada, it's probably a very inexpensive and easy transaction. But in California, I'm just guessing, and this is my guess, it's very difficult. I'm sure there'll be a lot of roadblocks, but somehow we get over them. But again, this is my opinion. I have no knowledge because I don't deal with any California corporations. What we have is a closely held corporation, recapitalizes in a non-taxable reorganization, transferring part of the capital stock to preferred stock. The common stock is then transferred to the next generation using minority and lack of marketability discounts over a period of time. That could be over a 20-year period, 30-year period. The common stock will appreciate, while the preferred stock owned by the owner will retain approximately the same value. So this is the nice value thing is here is preferred stock is going to act like a bond. As interest rates go up, the value goes down of the asset. As the interest rates go down, the value has to go up. That's not a big swing like you would have a common stock. So that we would expect the value to be about the same. So if you start out with a relatively small amount of preferred stock and give away all your common stock to your children and grandchildren over 20, 30 years, yeah, you're going to have a very small amount in your estate. The IRS requirements are you must follow the IRS rules since a gift of stock to a family member of a controlled corporation wherein the owner receives an interest, the retained interest will be valued at zero. And consequently, the common stock will carry the full market value of the business just as did before the recapitalization. So we want that to happen. We want the common stock to carry the full market value. And things we have to do, first of all, the donor has a right to qualified payments. And that means if it's a preferred stock, it's going to get titled to dividends. And dividends are typically paid 4 times a year, and that's what we would expect the preferred shareholder to get. The stock retained or given away is publicly traded stock. In other words, we don't restrict its ownership. The retained interest is the same class as the transferred interest. It's another way we can handle it. Retained interest proportionally the same rights as the transferred interest, or the retained interest in common stock, preferred stock is given to family members. All these are methods we can use to retain a valuation, the zero valuation for retained interest, which means we'll transfer in any one of these cases the valuation to the next generations. Calculation of the transfer, the value of the preferred stock first based on a calculation of the present value of the stream of dividends. Again, we have to use the IRS tax tables. Subtract this value from the total value of the company and determine the value for the common stock. This can be done by a bookkeeper. It is not difficult. And as in fact, I remember when I was doing this for a client, I was having my daughter who was in high school do the work on it. So it's nothing a big deal. Control issues. If owner retains rights to distributions from the company, Chapter 14 of the Code will apply if applicable family members have control of the business immediately before the transfer, and control is subject to attribution rules requiring the ownership interest of all family members be aggregated. So those are the control issues that they want, the magic words, and again, that's going to be in the agreement. Trusts are used for estate freezes. General rules that if grantor makes a gift and trust for family members and retains an interest in the trust, the retained interest will be valued at zero for tax purposes. And that's an example of the GRIT, which again is making a gift and retaining that value, and we want it retained in the common stock, and that's the same thing as a GRIT. And then qualified trusts, GRATs, GRUTs, TPPTs, and CUPE, qualified personal residence exceptions to the rule and require the remaining interest to be valued for gift tax purposes using traditional valuation methods. So we want the general rule. This is the summation of the week module 3. We could spend a lot of time on it. Quite honestly, it is not heavy on the CFP exam, and it's an area where you definitely have to have legal advice. I mean, there's no question of legal advice being required, and if you don't have legal advice, then you're probably going to have a real problem. I know a lot of CPAs try setting this up on their own, and quite honestly, I don't feel they have the due diligence nor the education to be able to do it. And for the, we're talking about businesses worth millions of dollars. So if you're paying $10,000 for advice, or even $20,000, it's nothing compared with the amount you're going to save in taxes. So I say that from a financial planning standpoint, what you have to know, and certainly for the CFP exam, is it's a tool that can be used for transferring assets to the next generation, getting around the generation skipping tax, drastically reducing your estate tax if you're a business owner. And it could apply to corporations, and where you use preferred stock, and it also can be used as a call in your textbook for partnerships, making it from a sole proprietorship or general partnership to a limited partnership, where you have the parents become limited partners and the general partners become the next generations. And that is it for this session.